Let's bring in Konstantinos. He's the Chief Investment Strategist and Director of International Equity at Riverfront Investment Group. Chris, overnight news, Brexit, the hard out may be in question, and also you've got in Hong Kong possibly thawing of some tension. What does this mean for an international portfolio manager?
Sure. A lot of moving pieces, right, over the last 24 hours. That's what makes this job fun. Let me touch on the Brexit thing first. I think this is important. So on the face of it, this looks like it could be a positive. Obviously, the pound is rallying some today on the news. I would caution investors not to get too excited about this. If you think about the pound, like I do, which is I think the pound represents the best single market barometer for the risk of a hard Brexit or a no-deal Brexit, then even with the rally today, the pound at 122 is still suggesting a relatively high probability that we have some sort of chaotic finish to this saga. And so we've been recommending investors to continue to avoid the UK, continue to avoid the pound for the time being. The nuts and bolts of this is, if they can pass this deal in Parliament tonight, this bill, then they can potentially block a no-deal Brexit in October, get an extension to the end of January. Boris Johnson has said that he would, at that point, call for a general election. It's unclear at this point whether he has the majority to do so yet, because he needs a 2/3 majority. So, again, I would just caution anyone who thinks that this is, that this story is over. I think we're still a long way from that.
I thought what was interesting as well, Chris, if I just jump in, is just the price action for the pound over the past 2 weeks, right? Driving all the way down below 1.2 on the intraday basis. To me was a little bit interesting because it seemed the notion was Boris Johnson equated to hard Brexit, but yet the market still had room to give up on the pound. So is there sort of a intrinsic hope that remains there?
Oh, absolutely. I think, in our internal probabilities, I think we're placing something around a 1/3 probability of an eventual no-deal Brexit, which is obviously still, that's less than 50%. And we think that, in a no-deal Brexit, the pound could go significantly lower, even from where it is today. Maybe that's 110 to 115. No one really knows for sure, but we think there's still room to the downside, even though it is close to a 20-year low at this point.
All right. So at what point, though, do we say, look, the thing, how much lower does it go without real evidence that the economy behind it is worsening? I mean, does the economy in Britain, does the economy and its connection to the Eurozone at this point look, rough enough to justify the move? Or is this, kind of getting ahead of itself on what could happen if it's hard Brexit? Meaning, is there potential for, UK economic data to start moving the pound?
Well, there always is, of course.
Yeah.
Economic data is always one of the major transmission, mechanisms into currencies. But, we're really on uncharted territory here. We've never had a historical event, either in Britain or elsewhere, anything quite like this. So, it's pretty hard to dimension out just what the risk to the currency is. One point I want to make, though, about the economy in the UK is that one of the big surprises from 2016 until the end of 18 was just how resilient the UK economy had been despite all the Brexit uncertainty. One of the things that we've picked up more recently, though, is that the consumer is starting to fade a little bit in the UK, and really importantly, business sentiment in the UK over the last few months, few quarters has started to drop as well, which I think is an important negative. Certainly the Bank of England has talked about this, and they've said that they're going to be on the case to the extent that they can be. But at the end of the day, that dropping in sentiment, I think, is a negative sign for where the UK economy may head as we get closer to October and the end of the year.
Chris, more generally, to kind of take a step back here in the strategy that you guys are employing right now when you think about international investing, with the U.S. dominance we've seen, both in terms of the S&P relative to its peers around the world, the dollar relative to the currencies, what is the potential for that regime to shift? I mean, what are the things that need to happen? I imagine some relief on some of the topics we're discussing are probably helpful.
Yeah, so what I can tell you is what we've been doing in our portfolios here at Riverfront over the last 18 or so months. And what that is has been bringing capital, international capital, back home. And that has been a pretty consistent process for us in the last year and a half. And it's been, because of the relative currency movements with the strength of the dollar. It's been because of the relative strength of the U.S. economy, particularly the U.S. consumer in relation to the consumers elsewhere in the world. And that's something that we're still advocating for. We still think that, for global investors, this is a good time to be overweighting the U.S. and underweighting both developed and emerging markets. What gets that regime to shift? I think you need some real certainties around some of the issues we see internationally, not just with trade, not just with geopolitics, but just old-fashioned economics. Germany looks like it's in recession. Italy looks like it's not far behind. Japan is teetering, depending on what happens with their VAT tax here at the end of October. China's economy seems to be stabilizing, but it's certainly slowing off the pace we've seen in recent years. So I think we need some more stabilization globally before some of those international assets, which admittedly we believe have good long-term value, but poor tactical indicators attached to them. We think we need some of that to shift before we get more aggressive in the international space.
Chris, from the central bank perspective and how it connects to some of those economic trends downward for Germany and the likes around the world, our question here, of course, is just how bad will the U.S. get and what does the Fed do to combat it, if anything? How important is that to your side of the market for those international equities? Are you watching as closely Jay Powell's words and everybody else that's talking today as domestic investors are?
You have to. I'm not just saying this as American. I'm saying this as a global investor and as a global citizen. The Federal Reserve is the single-handedly most important central bank in the world. It has the biggest impact on risk markets everywhere. So if you're an investor anywhere in the world, you have to be watching the Fed and trying to dimension out what you think they're going to do. I think yesterday's comments from Bullard and Rosengren were really interesting, right? Because you got the dual polarities of Fed views. You got the ultra hawk in Rosengren saying, hey, look, we only have 8 more cuts till we hit the zero bound. So let's take a deep breath before we cut anymore. You had Bullard on the other side saying, guys, we need to get out ahead of this, because once sentiment turns, that could be a negative self-fulfilling prophecy. Remember that I think the Fed under Jay Powell is what I would term a consensus-building institution. And I think that while yesterday's comments were very much the two extreme ends of the spectrum, at the end of the day, I think we're going to get something in the middle. And that suggests to me that the U.S. Fed is still very much on the case, still very keen to try to stay ahead of this. I agree with the Bullard's take on this, and I think you don't want to be too short risk assets, particularly in the U.S., given that the Fed put, in my opinion, is still out there.
Right. Now, Chris, if that changes at all, we spend a lot of time thinking about what it means for the S&P 500 and the Treasury market pricing in cuts as well, valuations, U.S. stocks. How about the rest of the world? We know that they are already at lower valuations, so maybe they don't, one could argue they don't need that same type of, backdrop. But if let's say Powell sounding too hawkish equates to stronger dollar or equates to a even bigger divide in interest rates between us and the rest of the world, how damaging will that be to international equities?
I still think there could be some downside there, and particularly in emerging markets. Emerging markets, in our opinion, are the most sensitive to dollar strength. And this is for a couple reasons, not least of which is because for some of the shakier economies in emerging markets, they have a lot of dollar-denominated debt. So as the dollar rises, their liabilities rise with them, which, left unchecked could create, certain credit issues in some of these regions. So emerging markets still looks like a pretty tough place to be if you think that the Fed is going to come out more hawkish than people are expecting. Again, though, take a step back. At the end of the day, I think the one thing we have seen from the Fed is that they're data dependent. And we saw a pretty surprisingly bad ISM print in the U.S. a couple days ago. Yep. We've seen the services PMI in the U.S. also drop close to that 50 threshold, that expansionary threshold. So I think that the Federal Reserve doesn't have a ton of room to be too hawkish here, in my opinion.
Yeah. All right, Chris, really good conversation. Very useful. Looking forward to seeing how it shakes out. Keeping our eyes on emerging markets as the dollar remains big. Chris Konstantinos joining us from Riverfront Investment Group. Really nice work. We'll be right back.
Thanks.